everybody, we're diving down into 4 dividend aristocrats that I find utterly fascinating as they recently just posted earnings. We're going to be talking about the Hershey's Corporation, the only company that Elon Musk described as a monopoly. We're going to be getting into Starbucks with the recent slowdown in their Chinese sales. We're going to be getting into Scott's Miracle-Gro, which is just getting largely hit from the slowdown in their MJ-related businesses. And then finally, the oil giant that, dare I say, is Exxon Mobile. If that is a conversation you can appreciate, let me know what you think in the comments section. While you're down there, of course, hit that like button, folks, because we got to talk about Hershey's here, man. This is a stock that's largely under talked about, and this thing has been crushing it. That's an understatement. They're trading up 13.9% year to date, crushing the S&P 500, and their dividend increases have been unbelievable. I mean, if you go back to 2013, they were paying 0.48 cents a quarter to today, where they're paying 0.9 cents, and over doubling of that dividend, which is just astounding. But the more I looked into this business, the more I realized that once upon a time, Elon Musk was calling it a monopoly. They basically own the entire candy industry. They have the exclusive sales rights in the US to Cadbury. They basically own Easter, for crying out loud. They own Halloween. I mean, they've got Reese's is one of their brands. Hershey's, Icebreakers, Kisses, guys, Twizzlers, Jolly Ranchers, Kit Kat. Anytime Halloween comes around, you buy those little boxes of mixed candy with Kit Kats and stuff. That's literally, they own every holiday at this point. Let's be real here, folks. And their earnings, because of their pricing power, did you guys see how expensive mini eggs were over the Easter season? Like, it was insane at how expensive the premium is on those candies. They're great candies. I had to buy some, of course. But their reported net income of $533 million and $2.57 per share diluted, an increase of 35.3%. These are the companies that have that true pricing power in these inflationary times. And God knows, guys, chocolate's like the easiest thing in the world to make. It isn't like a complicated process. So this company is just grazing through this entire market cycle like it isn't even happening. And just take a look at the historical averages on this, from the stock price to the net EPS here, guys, and then their PE ratio. They're definitely trading on the upper end of the PE. It would have been nice to pick it up on these dips, but this just wasn't a company I was paying attention to back here when they were having an earnings slowdown period. And I'd love to go back and see what caused this earnings slowdown, because they brushed that off like it wasn't even an issue here, folks. Now, Starbucks, a large favorite amongst many of the dividend favorite YouTubers out there, like PPC Ian, right, is probably pretty happy from this earnings period, because in after hours today, guys, the stock is trading up about 4.77%. Now, if you're reading headlines, you're going to see things like Starbucks suspends its outlook as the pandemic lockdowns hammer sales in China. They took a massive hindrance. Chinese same-store sales sank 23% in the quarter as the country reimposed the lockdowns, right? That is a massive hindrance here. Yet why is the stock trading up so aggressively here, folks? Well, global comparable store sales increased 7%, driven by a 4% increase in average ticket and a 3% increase in comparable transactions. Starbucks actually met all of their earnings expectations, primarily what was going to be expected, because they can just continue to increase prices on coffee. And these crazy Starbucksers out there, it's a weird way to call them that, Starbucksers, baristas, whatever you want to call them, they have been willing to pay these exuberated prices here in the Western world, really making up for the slowdown in the China sales. So here's a really good thing, guys. If you think after the lockdowns in China and things start to recoup, this could be a really good potential earnings growth for them coming into the latter half of this year. And this thing has been a dividend growth beast, more than, I'm going to say, something like even Hershey's has been. Because if you go back to 2013, 2012 timeframe, when they were paying about 17 to 20 cents, today, guys, they're paying about 50 cents a quarter. Just unbelievable insanity from a dividend growth perspective, right? But the stock is trading down massively. I honestly think this could be a huge buying potential. Now, they have some other problems like unionizations that have been getting a lot of talk going on, which could do some more hindrance to the bottom line EPS. But my God, guys, a 40% discount on a company that during all this mixed confusion in the global markets is still able to meet their expectations. Wonderful, wonderful stuff. And just take a look at it, because Starbucks, guys, coming in from like this chart here again with price, EPS, and then the PE ratio, this is a historical low value for them. Now, history, they had shown that they have hit the mid digits, like the teens here when it comes to their PE, but anytime you're getting into the teens in the low 20s is usually a good buying opportunity for Starbucks, right? So this is something that's very intriguing to me, though. I have not bought Starbucks. I personally prefer McDonald's because I'm just a fan of McDonald's over Starbucks. I've never enjoyed paying those premium prices for that coffee, but God knows people are willing to. So Scott's Miracle-Gro recently posted earnings here as well. This is one I get asked a lot about, and it kind of breaks my heart. I really thought this was the best play to the entire MJ industry, and not even this one could deal with the competitive nature, right? Like these guys do a lot with fertilizers, which isn't really helping their business right now, even though the fertilizer industry is blowing up. I'm not sure why. You'd have to dig down into that to figure all that stuff out. But again, it's just a shame here because this was like selling picks to the miners when we're talking about the MJ market. They made the acquisition of the hydroponics business, which grew their bottom line so much that they issued a special dividend back in 2020 of $5.62, which was astounding in the midst of that pandemic, right? And you have to think during 2020, this is when the stock just started to blow up aggressively, but obviously things have not gone in their direction. It really shows you how unpredictable the markets really are here, because I thought there would have been a lot of sustainability in a company like this, because their GAAP EPS was $4.94 versus $5.44 for kind of the same time period last year, right? And if you read into this, they're saying that the fiscal second quarter, the company reported sales of $1.68 billion, down 8% from $1.83 billion a year earlier. U.S. consumer segment sales increased slightly to $1.38 billion, whereas the sales from the Hawthorne segment decreased 44%, or $202 million. That's just brutal, right? Because that was all part of the MJ markets for them. And if we scroll down, guys, you can see the total cost, or the net sales have dropped 13%, right? Which is just brutal stuff. Now, from a price to earnings standpoint, probably not the worst buying situation here, because the company is still doing relatively way better than they were, say, 3 years prior. And the fact is their historical PE is usually in the 20s to higher teens, and right now it's trading at a whopping 13.94 with a 2.5% starting dividend yield. And that dividend yield, by the way, which we did brief over here, is this another crazy one? Yeah, so from 0.43 cents in 2013 to where it's today at 0.66 isn't nearly as attractive, again, as say something like a Starbucks or a Hershey's from a growth rate. But with that special dividend, it probably looked a lot juicier than it has been, because God, to pay a $5 special dividend, that's brutally insane, like brutally insane. So let's talk about Exxon Mobile. This is one that I definitely do not think is a buying opportunity at these levels. I figured these would be more for good swing trades. I'm going to explain to you why, because they did post some pretty great numbers here. I mean, earnings included identified items were $8.8 billion, an increase of more than $6 billion versus the first quarter of 2021, after adjusted for a $3.4 billion after-tax charge related to the company's Russia. They apparently had one operation in Russia, and they were still able to crush earnings. But if we actually take a look at the historical PE ratio and the EPS growth rate on this, for this earnings cycle here, guys, oh God, it's not exactly exciting to say the least. Because if we go back to a time period between 2012 and say 2015, this company had exceptional bottom line EPS numbers. And obviously because here in Canada, when you're dealing with this ESG stuff where they're getting carbon tax, the governments are taxing in certain countries, these big oil conglomerates, their EPS numbers are really only returning to a baseline that they saw back in the 2018, 2019 timeframe. So this thing is basically just recouping some of the prior share price that it lost during this time period going into the pandemic and, when oil fell off a cliff. So this is more for dividend and cash flow. I kind of consider these like my utility stocks. I think it's trading for fair value here, maybe a little above fair value, depending on how you look at it moving forward. Obviously, if oil prices and gas prices sustain higher areas like we're seeing, we'll stabilize here. But again, I think the most of the money's been made in this stock. And again, it's just fascinating to look at it, right? From even a dividend standpoint, because from 2013, they were paying 63 cents to where they're paying today at 0.88 cents. So again, not nearly as attractive as our Hershey's or Starbucks, or dare I say even our Scotts Miracle-Gro, but these are like the latter half companies that are just fun to look at for me. I don't particularly hold them, but I want to pass the question off to you. What do you guys think about these stocks? Do you hold them in your portfolio? When did you buy them? Where do you think they're going to go moving forward? I'd love to hear about all that. But on that note, stay cool, stay awesome, and as always, I look forward to catching you in the next one.